I worked with Chris Ailman to rearrange a few items, so as your chair, I will lead you so you can follow along, but I just wanted to give you a heads up that we're going to start with item 10. So we're moving to item 10, then we're going to go to item 11, 12, 14. We'll see where climate advisory goes from there. Thank you so much. And then we'll go back to items 8, 9, 13, 15, 16, 16A, and then go into closed session for the rest of the day so our members can go home and do other things. Okay? You follow that? So I will continue to kind of guide you along that. But we're going to start off with item number 10, which is an informational item from our colleague Alan Emkin from PCA. We're going to receive his semi-annual performance report. Alan.
Madam Chair, members, Alan Emkin, PCA. I feel like I've been here before. Yeah. Between your comments this morning, Madam Chair, and Mr. Ailman's comments, you've addressed the big issues that are in this report. So what I'm going to try to do is to highlight areas that might not be obvious. If you would just go to page 2 of our report, there are 2 tables. One compares your performance versus your policy benchmark, and one compares your performance versus the median. And Madam Chair, you addressed the median issue earlier today, but it's important to keep in mind that over a decade, you've beat the median by 40 basis points, and that's 40 basis points a year compounded with $100 billion. That's real money. And you did that with a large pool of assets, which is even more challenging. And that's congratulations to the board and to the staff for a job well done. The one thing I would like to underscore is if you look at the 5-year period, you don't look quite as competitive, and that's because of the significant negative impact that real estate had in the early part of that period. But part of the positive impact subsequent to that time is that the real estate portfolio, in fact, came back and has added value in the last 3 years. And I think that should not go unmentioned. In terms of risk, and that's under tab 2 of our report, the big takeaway is that I don't have your
Do you have the
book in
board?
front of me.
INV 184 and 185.
Just so people can follow along as we're discussing things.
And the Treasury bond during the period, the 10-year during this period, decreased in value by 9%. Since then, it's decreased in value more. And why is that important? Well, as we discussed earlier today, that was traditionally the anchor to windward at a place where you looked to diversify risk. In fact, that was where risk was centered, and we fear that that will continue to be the case. The other metrics are all pretty much in the same range they have been in recent periods. What I would do is urge you to look at, Chris, page 13. What is that on INV?
INV 194.
And what that does, it shows you back from 1980, the forward-looking real yield or inflation-adjusted yield of the 10-year Treasury bond in the top chart, and the duration or interest rate risk of that 10-year Treasury in the bottom chart. And what you see is that the real looking forward yield is close to an historical low. Now, it's ticked up a little bit since then, but it will still be an extremely low level, and that interest rate risk continues to be exceedingly high by historic standards. It's important to underscore how that gets changed. So for the interest rate risk to go down, the yield has to go up. And if the yield goes up, the price goes down. That's the math of bonds. Really, this is, it's not like equities, which lots of different ways to value them, but bonds, it's mathematical. And so the only way for this to go back to historical averages, assuming it does at some point, is for the price of bonds to decrease. And that's what most people in the industry expect to occur. If I knew when that would occur, I would be in a different line of business. Unfortunately, I've been saying that's going to happen for 3 years, and for 2.5 of those 3 years, I was wrong. Don't hold that against me. Page 23, Chris, what number is that?
INV 204.
That's page 23, and that's the asset allocation targets versus actual. And there are two things I want to underscore. The first is there was a significant underweight in fixed income that added significant value. And not only did the underweight add value, but your staff made a tactical bet and didn't have as much interest rate sensitivity as the benchmark, so value was added by their tactical decision. And you also, in the inflation sensitive, underweighted, and that part, which is primarily made up of tips, also did not do well during this period. And those two decisions added value. I was planning on having a whole series of conversations around how you've done versus your peers, but since that's already been addressed, I think it would be redundant and unnecessary.
Oh, no, go ahead, go ahead. No, I'm just kidding. One thing Alan has always said in the past, it's always fun to beat our peers, but we don't pay benefits to the teachers with our peer group rankings, so.
I would remind you that our CalSTRS staff, that they pay into CalPERS.
But the important thing from my perspective for you as policymakers to understand really where you're different than some of your peers and where it's added value, where it hasn't added value. Where it's added value is you have a benchmark for fixed income, which is, in quote, broad market-like. And relative to those peers who have longer duration benchmarks, in recent periods, you've significantly outperformed them. The other big difference between you and a number of your peers is your allocation to equities is not a global allocation, whereby in today's world you'd have slightly more non-dollar assets than you would have dollar assets. In fact, relative to that benchmark, you overweight domestic assets. In this period, domestic assets have far outperformed non-dollar assets, and that's accrued greatly to the portfolio's performance. That can change. And so if there's a period when the foreign markets, equity markets, do much better, you will not fully participate in that. But this has also been a period when the dollar has generally strengthened most versus other major currencies. So not having that non-dollar exposure also added value. Between those two, the fixed income benchmark and the dollar exposure relative to domestic versus international equity, that counts for almost all of the difference between you and most of your peers. I'd be happy to answer any questions. That's the big picture. For the public's benefit, on a regular basis, the staff looks at each individual manager and gives you what I call a report card, and we don't want to repeat that today. There's nothing in the portfolio that is extraordinary or that requires special attention and to be brought to your attention today. But there is one other area where other funds, those who did perform better than you, what the difference was. And the difference was, and that's primarily Washington and Oregon, is both of them have dramatically more private equity than you have. Well north of 20%, closer to 25%. And over the long term, that private equity has generated superior returns. And you, because of your size, are somewhat constrained, and your staff believes that that 13% is what they feel comfortable at. So versus your peers who are willing to take a much larger exposure, when private equity does well, which in theory should be most of the time that equity is doing well, though that small group of funds will do better than you. And I'd be happy to answer any questions.
Are there any questions from on? I'm going to channel, apparently Gary Lyons, my predecessor, used to ask these questions of our consultants, so I'm going to start that tradition again in his honor, and I think it's helpful. But is there anything else, given the conversation that we've been having, that we should be aware of, things that we should be looking out for, or that you haven't covered already?
Well, the single most important thing is we're almost 5 years from the, in quote, the Great Recession. Capital markets have a history of going up and then going down. Sometime in the next number of years, there will be another sell-off. Most of your exposure is growth exposure. That's the exposure that gets hurt in a sell-off. You should expect to have losses when that occurs, and there's nothing you can do to insulate yourself from that other than hold cash. And so you should be prepared. You should be very happy with the returns you've gotten in the last 3.5 or 4 years. But the market can be very brutal in taking a lot of that back. And it's just, you should not assume that recent past performance is a predictor of future performance. If anything, I would say you should expect much more modest returns, much similar to the expected returns that came out of the asset allocation work that you just completed. The only other observation would be you have a number of programs that have just begin to be funded. The staff is beginning to look at MLPs. I would just urge you to monitor that, and to the extent that they and you are comfortable, to put enough money at work there so it makes a difference, because the initial commitment is $200 million, and if we didn't think 5% was enough to do for private equity, we would feel the same way about other asset classes. If it's worth doing in size once you have a comfort level. If it's not, you shouldn't do it at all. You should save the time and energy and resources.
Okay. Thanks, Alan. I don't see any other comments from board members, so thanks, Alan. Great, that's the informational item, so we'll move on to item 11. Michaelin, this real estate semi-annual performance report. Hi, Michaelin.
Good afternoon. Michaelin McGee with the Townsend Group. I have been asked to give the board a little flavor for our view of the world, and so before I start that,
Finally, Michaelin.
finally, and so you won't find these slides in your books or in the materials, and I will be sure to get you a copy of our full view of the world as well as the slide deck that goes with that. But I did have some stuff in hand that I could use to put up here for the audience and for people to follow. A little bit of background. A View of the World is a formal document that's produced twice a year. It is created by beginning with each of the individuals in our firm who specialize in particular areas. We have I think we're up to 11 people now in our London office. We have 7 people in our Hong Kong office. We have about 60 some odd people in Cleveland. They don't do a whole lot of market overviewing in Cleveland. And then we have a San Francisco office. And for each of the areas that you see here, US, Europe, and Asia, we have individuals who are dedicated. They don't have client servicing responsibilities like I do. Their sole function is to understand the markets, the players in the market, come up with a view of that market and where the best opportunities are, who the best players are, and then working through our investment committee, we come up with a cohesive view of the world, the themes we're going to recommend to our clients for investment. And as we do the due diligence on each of those individual investments, if we were looking at an Asia fund, our folks in Asia would do the due diligence on that along with my support from the client's perspective. So it's a long and extenuated process. They've already started the new view of the world. It'll come out in November. This is our April version. So starting with the slide that's up on the screen, just walk you through what's here. The yellow lines, or yellow arrows, are what we felt at our last view of the world. And then the green arrows represent where we are today, and they're not absolute directions. They're just really meant to be more relative directions. Earlier in the year, we were a little more bullish on the U.S. We've been making recommendations for a number of U.S. investments, but the pricing here has got a little bit heated in some markets, and so we're moving away from the U.S. and more toward Europe, where we see a lot of opportunities for that market that's about 2 to 3 years behind us, and specifically in Asia, some increased focus on various Asian markets. And here's my clicker. Excuse me. The major part of probably the biggest point in our view of the world in today's market is that we have recommended, and your staff has concurred with, an approach that really is very granular. So instead of saying, when we talk about real estate pricing, whether it's overpriced, there are certain markets where there's absolutely overpricing, and then there are certain markets where there's great buys and great potential that still remains. We think that means that really it's more of a granular approach, targeted strategies, and as I go through each of the different geographic regions, I'll talk to you about specific ones that we've used or that you guys are investing in through your portfolio. We want to invest with managers where we think they can really drive the operating income of the asset. That means improving rental rates, increasing occupancy, retaining tenants. We don't see a huge economic recovery, and Chris's market overview earlier indicated that it's going to be slow and steady and not really robust. That means that retaining every tenant and getting every dollar out of your existing buildings are really important. That has led us to work more with direct operators than what we in the industry call allocators, managers who just decide which operator to use and how to dole out your money. We've been much more specific in our strategies. We think that you need to be a little more flexible in what you consider to be appropriate investments. And the main type of investment here is working with our clients who don't consider real estate debt or debt-oriented vehicles to be a part of their debt portfolio. And there is a great deal of opportunity. There was in the U.S. CalSTRS participated in that opportunity back in about 2010, 2011 for the distressed debt market, loaning to own and or providing debt when there is no debt available and getting some participation in those assets on the backside. We also think that investors can be working through the co-investment route where you really take all of the investments that a manager is looking at. They've decided to do 5 assets out of the 400 that they might have looked at, and they have additional capital needs for those individual assets. It's a great opportunity to really just be looking at the best assets available for any particular manager. CalSTRS participates in that through both their joint venture and through co-investment programs with your existing managers. United States, really the numbers when Alan Imkin gives you the numbers on what's hot and what's overpriced, it's really focused predominantly on the United States. Markets remain healthy, and the fundamentals are still improving, and they're doing so slowly. So that means that there is still room for rental growth. We did not, in the last market cycle, oversupply here in the United States. We didn't build too many offices like we did in the 80s. We didn't oversupply any of the property types really, and that supply, any development that was occurring stopped really in 2008, and has not really picked up for 2 reasons. One, people aren't very comfortable with the economy and its ability to lease out a building, and also because the financing for construction is still very limited. Banks aren't lending particularly in that area, and they're not willing to take that risk or can't take the risk because of the bank financial state positions. The spread to debt, and we talked about, there's 2 elements that they look at in the real estate area. There's the cap rates, and it's the inverse of what Alan was talking about with debt. A low cap rate means a high price. High cap rate means a low price. It is basically the percentage of income. If you bought a house for $100,000 and you can rent it for $10,000, that's a 10 cap. That's the price, and if you can do that, by the way, tell me where you can do that, because that's a great return. But the cap rate, so when cap rates go up, prices are going down. And so what we have now is very low cap rates. But we're also in an environment where interest rates are low. And so the spread over what you can get in fixed income and the ability to still continue to benefit from the economic improvements as we increase rents and occupancy leads us to feel more comfortable with the pricing than you normally would at the cap rates at which we're currently purchasing. Does that make sense? I'm a lot of buzzwords. I'm trying not to. Should give you guys little balls you can throw at me when I use a word you can't That's ours and
I'll
nobody
let
else's.
you know for sure, Michael, at least from my
Okay.
perspective. Thanks.
And that's really the third bullet here. Pricing in many cases is still below replacement cost. If you can't replace it for what you can buy it for, you won't develop. That helps us keep the supply in check, and it also helps pricing retain its values. We do expect further capital to be allocated to the sector. One of the insights that Townsend has an advantage in is that in the last few years, a significant portion of our growth, about 60 to 70% of it, has been in non-U.S. investors. And so having insight into where their capital is going, what they're going to be doing, and these are predominantly sovereign wealth funds with massive amounts of capital available for real estate investments. They're still not coming to the U.S. in particular because tax-wise it's a little bit of a challenge for them, but they are placing capital into the market, and that does change the pricing dynamics for U.S. investors as well. In Europe, generally we'd say that they are 2 to 3 years, maybe a little bit more behind us in the recovery. This year, Townsend did a lot of working within the distressed debt area within Europe. Your system also made a number of allocations to that within your opportunistic portfolio. The lack of debt in Europe continues to negatively price the assets that are there. If you can't finance it, people can't buy them because people are used to buying with leverage, and there's not enough equity available. So the pricing has remained pretty stagnant, and except for in very specific markets, flight to quality and safe, stabilized asset is being seen within the European regions. When we talk about Europe, we're including Poland, Slovakia, Eastern European as well. And there are a number of markets where people don't know as much about the markets or the operations of those assets, where there's great opportunity for core real estate internationally. Asia Pacific, for core, we are very favorable to Australia. Most of the Australian investor superannuation funds are looking to divest and diversify away from their Australian assets. They've had actually a much a healthier recovery than we have had, and they didn't go as deeply into the market collapse as most countries. So their stabilized assets are looking very favorable. We've done a little bit of China. Again, very specific. China is a difficult market to price into and to purchase and manage and repatriate capital. But we also know that the government supports and strongly supports the development and creation of retail and other end user assets that are in demand for those residencies, for one, in China, as well as the retail, are the two areas where Chinese citizens are spending a great deal of capital. And we did CITIC Retail Fund, was one of the funds that we did where it was very focused on retail, and it was, CITIC is a manager who is connected to a number of the government agencies that are supporting that growth. So that's the type of granular approach we recommend to our clients. Don't just go do China, or just don't just go do China retail. Make sure it's the right operator in the right place, implementing the right strategy that's supported by that particular country. India has been a tough market for us. We did some initial investments back in 2005, 2004. They did not pan out well, and one of the problems with India is that their government does come in and just change the whole game, stop your development, do whatever they want to do. So we've pulled back from a comfort level there. But again, the focus on retail and logistics, and we've not done the residential in China because we believe that could have a bubble, and if the Chinese citizens stop buying their second residencies because of tax implications, we could have a pullback on pricing there. Japan, we've worked a lot with the NPLs. We are now shifting, and you did some investments in those as well in 2010, 2011, maybe even in 2012. And we're focused now on the smaller NPLs because what's happened is a lot of the large allocator funds have raised a great deal of capital, and they're looking for those larger deals. So we're looking for those smaller entrepreneurial organizations that are purchasing the smaller assets, non-performing loans, and either taking back those assets or working out the financial restructuring of that debt. Logistics is huge in Japan. Their need for modern industrial facilities to warehouse and export Their goods is significant, and they are well undersupplied, and that strategy is being reviewed and offered through a number of funds that are in the market today. That's quick trip around the globe.
I love it. That's great. Thank you, Michael.
I will add that, I think I said at the beginning, we do have a formal written view of the world that I will provide to your staff for distribution, as well as a slide deck. Also, each time we do the view of the world, it is recorded by the individuals who did the underwriting and is available to you in a webinar to sit and listen to if you can't sleep at night. So we'll make sure you get those connections as well. It's really interesting. They can give you a lot more of, in those presentations, a lot more of the statistics, the data that's used to develop the position in each of those markets. I think there's another PowerPoint for the performance report. We'll start looking directly at your portfolio. I will mark my calendar that Mr. Emkin was complimentary of real estate today. And we are, as we've talked about in the last couple of quarters where we've done performance measurement, we're starting to see the benefit of the investments you made at the bottom of the market, as well as the repositioning of your portfolio that the staff has been doing at the behest of the board's directions. And in the last 3 years, looking very good. As the 5-year numbers, they still really look and reflect that GFC, the global financial crisis, and the decline in value, and the relative weighting of your portfolio, which had about 70% of your portfolio in high risk, highly levered, value creation strategies. At the time in the market where those strategies couldn't be implemented, leverage was negative, it compounded your returns, and you were really at a higher risk profile than the board was comfortable with. In my closed session remarks, I will be talking to you about the progress we're making strategically and tactically and moving the portfolio back to where it is and what needs to be done still. But on INV 289, I'm going to just move forward so we don't waste too much time. You have them in front of you, and I apologize to the audience. This is your total portfolio. With the core percentage of real estate at 37.7%, it is still below the 50% target, and we'll talk about that in the next couple of slides. And your opportunistic remains over-allocated, but it is significant to understand that when we began the market decline, you were at about 28% truly core real estate, and so significant strides have been made since 2008, 2009 in making new allocations, as well as recovering value in that core portfolio. And the opportunistic has been, even though we've made some opportunistic investments and continued to try to take advantage of the market recovery, we've been decreasing that opportunistic exposure as well.
Michael, can I just ask, when it has the red, the out of compliance, does that just mean we're not at our target?
You're not at your targets.
At our target, okay, thanks.
And at this point, if you look at the allocation range, you're not even within range. If you were within range, we wouldn't call it out of compliance. Right. And then if you look at INV 290, which is the next page, your staff has provided some cash flow projections indicating that, and actually this was as of the first quarter of 2013, and hot off the presses about a week after we did this, you actually will be at your 50% core by at the third quarter of 2013. So you will be in compliance and at your target. Your opportunistic will still be overweighted to where it's supposed to be, but your core assets have been increasing. One of the ways that that's increased, we will talk about in closed session, and that is a transfer of assets from your non-core portfolio that are expected to be long-term core holds. And it's what we call a build-to-core strategy. Instead of going out today and pricing in the market with all the other core assets and everybody else that wants core assets, you are, through your non-core portfolio, taking leasing risk, some development risk, re-tenanting risk, moderate risks in that sector and appropriate for that portion of your portfolio, stabilizing those assets and then transferring them into the core portfolio, as well as allowing up to 20% of your non-core portfolio to be in lower risk, stabilized or core assets that have like real short-term risks associated with them as far as lease up or tenant occupancy. And again, more detail on that in closed session where we can talk about specifics. IMB 291 shows the portfolio's time-weighted returns, and you can see where at the 3-year we're beginning to pick up some steam and perform better, especially in the 1 year and the most recent quarter. The 5-year and 10-year continue to lag the market. On the next page, really trying to show that your instructions have been followed. There we go. The dark blue column represents all of the investments that have been made in your portfolio as new investments since the market correction in the last 3 years. And you can see that those are outperforming all of the benchmarks and the various industry indices. And this includes all risks, core and non-core. So that's actually, when you compare that 23% in the 3-year to the NPI gross of 14%, that is a really strong, solid return. Next page refers to your geographic diversification. We talked a little bit about that in the view of the world. On the left-hand chart, we would consider the apartment exposure in your portfolio to be extremely advantageous. The limited exposure to office is also in your best interest at this time, given the market opportunities for office and expected economic growth. The industrial is probably the next property type we believe will move forward in the market and have a substantial recovery, and you are well exposed there. Probably a little bit more to that would be helpful. And this is the one, I believe, I'm looking, I think we have, we're, yeah, I'm sorry. And then other is really property types that aren't in the main 5, including hotels. These consist generally of medical office buildings, student housing, single-family housing, self-storage. These are the asset types that we think are really actually very compelling in today's market because they're all driven by demographics instead of economics. You don't need an economic recovery to have a demand for medical office building. You need good demographics, and unfortunately for many of us, there's a huge aging population. There's a big move to medical facilities where care is given outside of the hospital on an outpatient basis. All of this supports the need for good medical office buildings, and regardless of the political success of Obamacare or any care programs, the basic provision of medical health care is going to continue to have a high demand, and those types of assets in that other category are really a differentiating factor in performance going forward. It will not correlate to the other property types. They have their own drivers, and they price differently because they take special operation, and there are not as many managers who can manage those particular assets. On the geographic diversification, we're very comfortable with where you are today. You're in a good position to capitalize on the western regions and the East Coast regions' basic movement through the markets. If you look at the core markets where we talk about where assets are really well priced and heavily priced, it's New York, Boston, San Francisco, LA. That's where you want to have your exposure to existing assets. And with respect to that, I should point out that you have also been participating within your core portfolio very heavily in the disposition of assets that aren't perceived to be well positioned to go forward, but are in high demand because people want to simply be in those markets at any price. And so your managers have been taking care of that. Your other exposure is the international, and we'll talk a little bit about that in closed session, but a lot of your international exposure was in your early year non-core investments. They are liquidating over time, and so your staff and Townsend are working on opportunities for you to gain additional non-U.S. exposure. We did find in the market collapse, despite the feeling that the entire world all went down, the markets went down at different rates and different ways and at different times than, and certainly in the recovery process, than just the U.S. market. So that diversification we know is a benefit. It's kind of anecdotal to us because we watched our U.S. portfolios decline much faster than our non-U.S. portfolios that were centered in their own domestic markets. By strategy, this is your core portfolio. We talked about this slide last time, and we kind of got caught on CB Richard Ellis. So I want to talk just specifically about the top two managers and point out a number of things that would be important for the board to understand. Beginning with the fact that in this market cycle in the last 3 years and even in the last 5 years, the best performing property type has been apartments, and the others have been fairly moderate to good performance, but nothing exceptional. Principal and CB Richard Ellis are both prohibited from doing apartments. They happen to be invested in retail and industrial, and then office and industrial for CB Richard Ellis. They're well positioned to capitalize on the industrial property type recovery we expect going forward, but they could not participate in the market recovery that we saw in the last few years because it was mostly multifamily. We have met with and discussed the performance with both managers. Your staff has removed assets from both managers and transferred them when they didn't feel they were being optimized. Assets have been sold, but they do still continue to be two of your largest managers. If you did a search today for a core managers, these two would come up. So it's really about working them through the assets and making sure that what you end up with is a high-quality portfolio you want to work forward with in the marketplace. The rest of the managers are just, these are your, just the top assets that represent the largest 74% of your aggregate portfolio, and their impact obviously is most significant relative to the rest of your core portfolio. I'll just highlight for you that quarter and 1 year return where we're really, your portfolio is doing very well. That represents a lot of your new, most recent investments. And even at 11.7 for the 3 year, you might not have hit your benchmark, but you certainly had a great return from a core portfolio that is, generally speaking, about 70% income generated for the system, and the rest of it is market.
Glenn, I have a question from Tom.
Yeah.
The restrictions on principal and CV Richard Ellis, were they restrictions of mandate or?
Yes, their mandate. And it's generally done, staff might be able to give you more history, but generally what it's done so that you don't have 18 managers all trying to compete for the same property and you're basically competing against yourself.
Right.
And then generally speaking, it's what they're best at doing as well. The next portion of it to look at is the value-added portfolio. These are the assets where you're taking either leasing, re-tenanting, some level of rehab, renovation, moderate risk but not significant, and the idea is to take those assets, stabilize them. When they become stabilized, they can be retained in your core portfolio if they're in separate accounts. If they're in funds, they are liquidated and sold into the market. The value-added portion of the portfolio did not do well in the market decline. And actually, if you, in 2009, if you did an asset allocations model of a real estate portfolio to optimize the real estate portfolio, it would say 0% value. It did so poorly in the market. And it was because we started to buy value-added assets thinking that we were going to lease at 5% and 6% rental increases forever and ever. A market didn't hold up for that. And you ended up with a bunch of assets that were never going to get to the value expected or justify the price that was paid originally. So it's had a long market in working out. You can see that you still continue to underperform and have negative returns in some of the periods. That we think will stay here for a little bit longer because you have to get to the point where you can re-tenant, release, and get your huge market decline that occurred in 2008 to be out of that rolling 5-year number and allow for go-forward performance that shows the market recovery. This is the vintage year analysis. This is one of the new things that we can do with the, and I will tell you, we've got a lot more detail in the reports than we used to have. Private Edge has been extremely helpful in working with staff and creating new charts, new graphs, and new numbers that we can actually work with. This is comparing each of your vintage years with the performance of those vintage years, the rest of the peers. So what you have here is, for instance, in 2005, your market value today, that remains today, your net IRR to date is, probably picked the wrong year. Let's go with 2004. That net IRR is 4.7, which puts you still at a bottom quartile performer. Your median performer is 8.6, and the top quartile performer would be 9.8 for all value-added strategies. What's important to understand here, first of all, is for value, the expected return is somewhere between 10 and 14. So if you look across those vintage years, nobody was doing what value should have done. Nobody really got paid for the risk that was taken. And if you looked at what we believe will going forward, you did not do any value in 2008, 9, and 10. If you did it in 2012, and I believe you did, those vintage years are not yet available. They're not statistically accurate, viable. So this just gives you a perspective of your historical positions. And again, much of that 05, 06, 07, that's, by the way, 05 is when Townsend called the peak of the market, and we were wrong by 3 years as well. As Mr. Emkin was talking about earlier, didn't collapse until 2008. But 2005, 6, and 7 do represent peak market vintage years, and those vintage years are not expected. In those vintage years, you are really doing well if you get to a 1.0 multiple, if you get your capital back. That applies even more so to your opportunistic portfolio. This is your top managers for this portion of your portfolio. This continues to be the drain on your total plan. It represents a significant portion of your market value at the peak of the market and continues to represent a significant portion of your assets under management. Returns are improving, but again, pricing when we went into these markets was so high and at such peak values that many of the assets won't ever recover back to value. Again, a 1.0 multiple is something to really be happy with if you can get there, and a positive IRR as well. This does include some of your newer investments, but they would have very limited short track records and not much impact given the relative weighting of the new dollars going out versus the old dollars that were already in the portfolio. This is the vintage year analysis for your opportunistic investments. You do have 2 years where you are outperforming and doing well or performing well relative to your peer groups. And for the remainder of the years, as you move into the peak markets, 05, 6, 7, you can really see the impact of that market on those returns. You have a very small public portfolio, but this highlights those portions. These are predominantly shares and I think actually all shares that have been returned to you in lieu of distributions or in some kind of a public to private to public strategy that was purchased at the outset. And that is it. I can take any questions you have or comments, suggestions.
Any questions from committee members? I don't know if you heard Mike Lynn, but I actually took a real estate tour with Mike DeRay and I think Michelle Cunningham.
Yes.
They came down to Los Angeles, and it was, I commend if any board member wants to take a real estate tour in your neck of the woods or something. It was helpful for me because I feel like when we talk about this, it's just very, I like having a tangible picture of the kinds of investments we're making. So we toured an industrial storage area, apartments, some redevelopment areas. And so I think, and it was nice to meet some of the people we're doing business with. And so I think it was helpful to kind of give a sense. I know it was a picture and probably a very good picture of the investments that we're doing, but I just wanted to, say thanks to Mike for the tour. And I think, for us, it's easy for this to be numbers, and it's helpful to kind of look at the kinds of properties that we're investing in. So if board members want to do that, that's an option for us if you have the time. It took it the whole day.
You always feel like we know what they look like. We know. You tell me there's a building there, I assume there's a building there, but it actually really is very insightful to see how the managers are talking about the asset. That's where you really get a sense of those operators and what they're doing to pull value out of the assets they manage for you. Great.
I don't see any other comments, so thanks, Michael.
All right, thank you.
All right, so we're going to move on to item 12. So Mike Moy, PCA, Private Equity Semi-Annual Report. Hi, Mike. From Michael and to Mike.
Mike Moore from PCA to talk about private equity. I'll run through this quickly, and if you have any questions as I'm going through it, please feel free to shout. INV 379 depicts the performance. We point out and have pointed out over the time periods for quite some time that since it's a long-term asset class, that instead of focusing on the 1 year or quarter numbers. We should be focusing on the 3, 5, 10, and since inception, because that's really why you're in this asset class. You can see on 379 that there's been let's call it a mixed bag of relative performance versus your custom benchmark, which is essentially a public market index plus 300 basis points since 2008. You've underperformed. I'd say most of that underperformance is really driven by the inability of the private markets to capture currently upward movements in the valuation of companies that would be associated with the public markets. The public markets move much more rapidly than the private markets do with respect to valuations. When you look at versus the private equity industry benchmark, which is more of an averaging process, you can see that your performance is much more in line with that. I think you can also see, though, that the absolute performance with respect to the program has been above your return expectation that's being used in your asset allocations, which on a, let's call it an absolute basis, looking for where you're going to pay beneficiaries from is going to be the absolute returns that are coming out of the private markets. If you go on to page 380, you'll see that almost 3/4 of your portfolio is directed to buyouts, and 63% of that roughly is in mega buyouts, which is somewhat of a drag because the mega buyout space is not going to be generating returns at the level that they did historically. So until those get worked through, there's going to be somewhat of a suppression in returns. But with the, let's call it the upward movement of the public markets, hopefully that is going to diminish in terms of impact, but there's no way to predict the outcome on that. Distressed debt is about 12% of your market value, and you were early committers to that. You started in 2007. You kind of got in a little bit before the crowd, which is not necessarily good when you're doing distressed investing, because there your money is made on the buy. You've been continuing to commit to the space, which I think from a investment perspective is prudent, because I do believe we're going to see pockets of distress which are going to be addressed by the private equity managers that are operating in the distress space. 54% of your commitments are in the 2005 to 2008 time period, which is not advantageous from a pricing perspective, because that's when multiples were really escalating dramatically. And historically, when you have a bad purchase environment, you usually have underperformance going forward. The rebound in the public markets, I think, has mitigated that to some extent, but whether it will continue to do so is unknown. Probably in the next 2 to 3 years, you'll be out of those investments, hopefully. If the distributions that you have received recently are indicative of what you can be getting over the next 2 or 3 years, that portfolio will be coming down pretty dramatically. IVNV 381, we talk a little bit about the industry trends. There's not much really in there to focus on. You can see that the buyout commitments that were achieved in the first half of the year are well below what's gone on in 2007. I don't think we'll ever see the return of 2007 commitments. At least there's nothing that I see going forward where it's going to get back to that level. Venture capital, I think, continues to trend downward, which I think a number of people are viewing optimistically in terms of that's the place to be playing. You are confronted with the dynamic issue of being able to make commitments of sufficient size to warrant your participation in that. And most big investors have avoided it just because of the economics of trying to write smaller checks to managers. You've been cash flow positive since 2011, and that's because the private equity managers have really taken advantage of the marketplace in terms of divesting themselves of portfolio companies, and they've generated a lot of cash flow. So that, to me, is something that will eventually run off. When that's going to run off, I can't forecast, but it's been, I guess I would say, be thankful. It's been good. Let's hope it continues for a good period of time. All of your allocations are within range. Vintage year, since 90, you've outperformed the median 21 of 23 times. You've missed 2, and on one of those was by 1 basis point. So that's pretty good track record. And more than a quarter of your vintage years have been top quartile performance, which is pretty good from a portfolio perspective. On INV 387, we did a little color coding, which for some of you who have color issues, my apologies, but we thought it would give you a better, let's call it, depiction of, from a trend perspective, to look at how the performance is going. The 10-year numbers and the since inception numbers appear to be strong. The 1, 3, and 5 are not. 5 and 3 are particularly, well, 5-year is really impacted by 2008, the crisis. And 3 and 1 are kind of mixed bag because of what's going on in the public markets right now.
Can you just, with distressed debt, can you just explain that a little bit?
The reason distressed debt is underperforming in the, let's say, the 4 periods before the current year is a timing issue. You got in sooner than the average investor. So when you get in sooner, you buy at a higher price. So your performance numbers are depressed. And
That was 10 years ago, or when was, I'm just trying to get a sense of when was.
I can't answer the question on
Okay.
the 10-year number. I don't know specifically back then what the managers were, but in the most recent time periods, the 3 and 5 year, you were early into the space, and I won't speculate. I just don't know the reasons on the 10-year and since inception numbers.
Okay.
The proactive portfolio on INV 393 continues to perform at a level which warrants the attention of staff. It's something that they're watching closely with our encouragement, and it's I don't have a good forecast in terms of what's going to happen there, but it's been specifically identified historically as the bucket which would be used for certain types of investments, and they have had very mixed performance, and they've made a couple of commitments recently, or in the past year, let's say, to fund of funds managers that operate in the space. And I don't know what the future for it holds, but it is something that warrants attention, and staff is paying attention to it. There have been 13 commitments made since October 1 of 2012, which are depicted on INV 396. And that's been pretty consistent with what, from a budgetary perspective, in terms of the capital commitments that the program was supposed to be making. The one thing that we've seen in the marketplace that is of concern, but being able to quantify it, let's call it industry-wide, is not really possible. But particularly in Europe, we've seen a lot of sponsor-to-sponsor transactions where manager A sells to manager B. It's a portfolio company, and if you're an investor in A and B, you have the gain over on A and you have the purchase price in B. And that's something that, if it becomes really rampant, is really troubling, because it becomes one of a gaming issue. And it's very difficult to, let's call it, control, because many times manager B does have a plan for the portfolio company that manager A was not able to do, and they do it. But there are occasions where manager B can't do much with it, and it's a problem. But it's pretty isolated, but we're seeing more of it, particularly in Europe. Some of it's in the US. And the other thing that we're seeing is there are far more covenant-light debt instruments being written today than there were 2 or 3 years ago. We got away from it almost totally during the financial crisis, but they're back in the marketplace. They do provide you with, let's call it operating and negotiating leverage as the managers are trying to work through the companies, but they do have a downside to them that, as a practical matter to the lenders. So it's something that bears watching. Don't have a real good assessment as to how pervasive the issue is. I know that staff has looked on a sort of a snapshot basis at what the distributions, how they arose over the past 12 months. And it seems like roughly a third of distributions are coming in from instruments that are either recaps or debt instruments, et cetera, which is not really unusual, but it is something that, the recaps particularly are something that's of concern, but they're a relatively small piece of that 1/3.
Can you talk about that more, Mike? Why is that concerning? And I mean,
A dividend recap is where a manager puts leverage onto a portfolio company, and that portfolio company turns around and pays a dividend out to the owner, which in turn gets distributed to the LPs. And a number of managers, that's the way they create distributions. So they wind up with a portfolio company that has more leverage on it than typical. And the leverage is available because the lenders are in a mood to make loans. Well, that works well as long as everything is going up. But if you remember the crisis, everything went down, and those types of situations became ones where the ability to carry that debt, the portfolio companies were unable to do it. So you wind up with a portfolio of companies that are way over leveraged, and the only way out is to either go through some sort of rationalization or bankruptcy. So that's the reason it's an issue. Other than that, I'd be happy to answer any questions.
any questions from committee members? I forgot to ask Michael in this, so I'll ask her this in closed session, but anything else that you think we should be aware of? Or if you were, sort of able to kind of give a few bullet points for our staff, what in sort of encapsulating your report, what are things that we should be looking out for with private equity?
I really don't have anything specific. What I'm seeing among investors right now in the private equity space is more of a, let's call it, a movement to try and suppress the costs of doing private equity investing. The larger investors are all migrating towards doing that through co-investing because they can do it without fee and carry. But that is bringing to the table the issue of, let's call it investment selection, because it's very difficult to say this co-investment here will outperform versus this one here, which will underperform. And the track record is mixed. I mean, it's not, the obvious answer from where I have sat and people have asked me, what do you think GP should do? And I say, well, rather than do co-invests, they would be better off lowering their fees and potentially lowering their carried interest so that the economics would be changed for everybody. So right now, they listen, yeah, nice going, Mike. They just, continue it because it's a real hassle for them. Because when they're effectively trying to do a transaction and they decide, well, we will syndicate out 25% or whatever the percentage is of the deal, they almost have to have a separate marketing team to go around to the LPs who've asked for co-investments to convince them that this is a co-investment that they should do. So they have another dynamic they have to deal with throughout a transaction. Some would argue it's cyclical, it'll go away, but right now we're in the cycle where everybody's migrating towards that.
I'm going to have a question from Michael.
The dividend recap. I was just curious because typically, if I recall correctly, the dividend recap was done, I guess at its best, is done to actually buy out a certain percentage of the investors so that the investor receiving the dividend is not necessarily saddled with an investment in and an entity that has a portfolio that is different than the one that it originally invested in. But I think I hear what you're saying. What you're saying is that it's just a way to distribute out some income, just to keep the investors relatively mollified for the time being, with the hopes that the market will come back and save their butts.
Well, it's not usually done at times when the market is, let's call it, going in the wrong direction. Markets are pretty robust, but it's a way of making distributions to investors. So the investors will be quiet. I mean, they won't be seeking, well, why aren't you selling this? The cynical side of it is, well, but you could have sold it if you marketed it to go out and sell it. You would have, made the distribution. You wouldn't be continuing to collect fees. You wouldn't be continuing to do a number of things. So and everyone's got a different story, and you have to be sort of gentle, but, at the end of the day, if you have something that's left with too much debt on it, and the market goes away from you, you've got a problem you got to deal with.
No, that's something I think we should watch very carefully. Okay, thank you.
Great, thanks, Mike.
Okay, thank you.
Okay, those of you playing at home, we're skipping item 13 and we are at item 14.